The new individual income tax rates are 20%, 25%, 30%, 32%, and 35% until 2022. By 2023 and onwards, 15%, 20%, 25%, 30%, and 35%. Special aliens are now subject to the normal income tax under the Train Law. State under judicial settlement and irrevocable trust are no longer considered artificial single persons for income tax purposes. Hence, these juridical persons cannot claim personal exemptions of $20,000 beginning 2018 under the Train Law. The fringe benefits given to managerial and supervisory employees is now subject to the new 35% final withholding tax. Under the tax code, old, the tax rate applicable shall depend on the classification of the recipient of the benefits. Compensation income earners whose annual gross salary is 250,000 pesos and below shall be exempt from income tax. His salary shall likewise be exempt from withholding tax. The exemption shall include his hazard pay, holiday pay, overtime pay, and payments for night differentials. Benefits of 90,000 pesos and below received by an employee over and above his basic salary shall be exempt from income tax under the Train Law. Interest income from foreign currency deposits in banks shall be subject to the 15% final withholding tax under the Train Law. Lotto and sweepstakes winning of more than 10,000 shall be subject to the 20% final withholding tax. The tax base of the capital gains tax of 6% in the selling of capital asset is now the higher figure between A, the zonal value, and B, the fair market value as determined by the provincial or city assessor where the property is located. The gross selling price or consideration agreed upon between buyer and seller is no longer used. Self-employed businessmen, sole proprietor, and professionals, board and bar passers engage in the practice of their profession like they're not employed but on their own, realizing an annual gross sale or gross receipt of more than 250,000 to 3 million can choose between the 8% flat tax or the graduated schedule of tax rates under the Train Law for income tax purposes. If an individual in business or profession uses the accrual basis of accounting for his income and deductions, the optional standard deduction OSD of 40% shall be based on his gross sales during the year, whereas if he uses the cash basis of accounting for his income and deductions, the OSD shall be based on his gross receipts during the taxable year. If the taxpayer is a compensation income earner and at the same time is self-employed in business or in the exercise of his profession, the compensation income shall be subject to the graduated rates of tax under the Train Law, and the self-employment or professional income may be subject to either the 8% flat tax or the graduated tax rate. A mixed income earner is not entitled to the 250,000 pesos exemption on self-employment income because such amount is already incorporated in the first tier of the graduated income tax rates applicable to compensation income. X is an employee who receives a monthly salary of 18,500. Her 13-month pay and other allowances and benefits amounted to 105,000 per annum. Her holiday pay and overtime pay amounted to 36,000 pesos last year. Is X exempt from income tax and withholding tax under the Train Law? Answer: X annual compensation income is 222,000 pesos, 18,500 times 12. Her allowances and other benefits taxable is 25,000 pesos, in excess of 90,000 per annum. Since her total salary for the year is only 247,000 pesos, 222,000 plus 25,000, which is below the threshold of 250,000 pesos, X is exempt from income tax and withholding taxes. Her holiday and overtime pays are both exempt from income tax and withholding tax as well. Number 2. X is a supervisor in a manufacturing concern. His monthly salary is 32,500. His living allowances and other benefits is 5,300 per month. In the month of December, he receives his 13th-month pay plus Christmas bonus of 40,000 from his employer. A. If X comes to you seeking advice on how to report his income under the TRAIN law, what will be your advice under the given facts? B. If X works as the manager of an accredited NGO that is exempt from income tax, is X taxable on his compensation income? Answer to letter A. Total salary for the year, 32,500 times 12 is 390,000. Amount of benefits in excess of 90,000. 5,300 times 12, that is 63,600 plus 40,000 minus 90,000 pesos. 13,600. Total taxable income for the year is 403,600. The first 250,000 of his salary is exempt from income tax. 403,600 minus 250 is 153,600 times 20% equals 30,720, less creditable withholding taxes if there be any. Letter B. X net compensation income of 403,600 is still taxable. The determination of whether or not the same is subject to income tax is the total amount he received from his employer by way of compensation. X cannot invoke the exemption of his employer because tax exemption is non-transferable. Number 3. X total gross annual salary from employment is 300,000 pesos, 25,000 per month. His total monthly contributions to SSS, PhilHealth, Pag-ibig, union dues, and company group insurance is 4,825 per month. Is he taxable under the TRAIN law? Answer. He is exempt from income tax for the following reasons. Salary, 25,000 times 12, costs 300,000 pesos, less non-taxable SSS, PhilHealth, Pag-ibig, union dues, and group insurance contribution, 4,825 times 12, costs 57,900. Total, 242,100. The above-named contributions mandated by law are exempt from income tax. X net compensation income, after the deduction thereof, is below the threshold of 250,000 pesos. Hence, X is exempt from income tax. Number 4. X operates a small laundry shop while also practicing his dental profession. In 2018, his gross sales amounted to 1.1 million, in addition to his receipt from dental practice of 1.6 million. The cost of sales and operating expenses incurred on the laundry shop were 650,000 pesos and 190,000 pesos respectively. The cost of services on the profession was 850,000 pesos. A. Compute the tax due if X uses the 8% flat tax, and B. the graduated rates of tax. Answer to letter A. Gross receipts from laundry shop, equivalent to 1.1 million. Gross receipt from dental profession, 1.6 million. Total receipts, 2.7 million. Less first sum exempted, 250,000 pesos. Taxable income, 2,450,000 times 8% tax rate. Income tax due 196,000 pesos. X choice of 8% flat tax will exempt him from the payment of income tax and 3% percentage tax to the BIR. This choice of 8% flat must be made during the first quarter of the year or on the initial quarter return of the taxable year after the commencement of a new business or practice of profession. Failure to signify this choice during the said period, the taxpayer shall be considered as having availed of the graduated rates of tax under the train law. Such election shall be irrevocable, and no amendment shall be allowed for the taxable year. X shall not be entitled to avail of the optional standard deduction because he is taxed at gross. Financial statements (FS) is not required to be attached in the final income tax return, but existing rules and regulations on bookkeeping and invoicing or receipting shall be applied. If during the taxable year the X gross sales receipts exceeds 3 million, his income tax shall be computed under the graduated income tax rates, and he shall be allowed a tax credit for the previous quarter's income tax payments under the 8% flat tax. Letter B. Graduated rates of tax under the train law. Receipts. Gross receipts, laundry shop 1.1 million, less cost of sales 650,000, gross income 450,000, less expenses 190,000, gross receipts from profession 260,000 pesos, 1.6 million gross receipts from profession less cost of services 850,000 equals 750,000. Taxable income 1,010,000. Income tax due is 800,000 equivalent to 130,000 in excess of 800,000 equals 210,000 times 30% equals 63,000 and a total of 193,000 tax due. Since X has chosen the graduated rates in the computation of his income tax payable, he shall pay the 3% percentage tax. Hence, total receipts from laundry, shop, and profession is 2.7 million times 3% equals 81,000 pesos. X can avail of the 40% optional standard deductions in claiming his expenses. Number 5. Who are the taxpayers who are not allowed to avail of the 8% flat under the train law, notwithstanding the fact that they have not exceeded their gross sales or receipts of 3 million per annum? If the business or profession of the taxpayer is VAT registered, if the taxpayer is liable to other personage tax, which is not 3% non-tax, example franchise tax, common carriers tax, amusement tax, stock exchanges, etc. C. The taxpayer is a partner of a general professional partnership by virtue of their distributive share from the GPP, which is already net of costs and expenses. 6. What businesses are covered by the other personage taxes under Title 5 of the NIRC, which are not qualified to avail of the 8% flat tax of the train law? Answer. A. If the business or profession of the taxpayer is VAT registered. B. If the taxpayer is liable to other personage tax, which is not 3% non-VAT, example, franchise tax, common carriers tax, amusement tax, stock exchanges, etc. C. The taxpayer is a partner of a general professional partnership by virtue of their distributive share from the GPP, which is already net of costs and expenses. What businesses are covered by the other personage taxes under the Title 5 of the NIRC, which are not qualified to avail of the 8% flat tax of the train law? A. Businesses subject to franchises tax. B. Amusement taxes. C. Tax on insurance companies and agents of foreign insurance companies. D. Tax on international carriers. E. Tax on common carriers and keepers of garages. F. Tax on overseas dispatch and communications. G. Tax on winnings, jai-alai and horse races. H. Tax on sale, barter, exchanges of shares of stocks listed in the exchanges. I. Tax on banks, Q-banks, and financial intermediaries. 7. X operates a business subject to 2% franchise tax. His gross receipts are $2.750 and his non-operating income is $120,000. Costs and expenses for the year is $1.2 million. Compute his income tax payable under the train law. Answer: X cannot use the 8% flat tax because his business is covered by the other percentage taxes. Gross receipts $2.750,000. If X desires to use the OSD, add non-operating income, which is $120,000, gross receipts $2,750,000, total $2,870,000 pesos. Non-operating income $120,000, less cost expenses of $1.2 million, total $2.870. Taxable income $1.670, less first sum exempted of $250,000, less first sum exempted $250,000. Net taxable income is $2.620. OSD 40% of $2.750. Train rates $800,000 at $130,000 pesos, $1.520,000. In excess of 800K, Q equals 620,000 times 30% equals 186,000. Tax rate under the train schedule. Income tax payable 316,000 pesos. Excess of 800,000 equals 720,000 pesos times 30% equals 216,000 pesos. Income tax payable is 346,000 pesos. In 2018, X, a bank cashier, earned an annual compensation income of 480,000. Her 13-month pay and other benefit amounted to 89,500. In addition, she is a licensed real estate broker and appraiser with gross income of 2.5 million. Her cost of services and operating expenses were 570,000 and 390,000, respectively. During the same year, she had a non-operating income of 125,000 pesos. A. Compute the income tax due on X if she opted to be taxed at the 8% flat, and B. The graduated rates of tax under the train law. Answer A. If X chooses the 8% flat, she has to compute separately her income tax due from her compensation and from business, and thereafter to aggregate the two in arriving at the income tax payable under the flat tax on her compensation income, on her business income. Total compensation income 480,000. Gross receipts 2.5, less non-taxable benefits 89,500. Add other non-operating income of 125,000 pesos. Taxable compensation income 390,000 pesos. Taxable income is 2.625,000 pesos. On the first, 250,000 exempt times 8% in excess of 250,000 pesos, equivalent to 140,500 times 20% equals 28,100, 210,000 pesos. Therefore, tax due is 238,100, sum of 28,100 and 210,000. Note: the choice of 8% flat will exempt X from the payment of the 3% percentage tax. B. Graduated rates of tax, combined income from compensation on business and subject to the graduated rates. On business income, on compensation income. Gross receipts, 2.5 million. Total salary, 480,000, less cost of services of 570,000 pesos, less non-taxable benefits of 89,500. Gross income, 1.930,000 pesos. Taxable compensation income, 390,500. Less operating expenses of 390,000. Net income from operation, 1.540. And non-operating income, 125,000. Taxable business or professional income is 1.665,000. Total taxable income from both is 2,055,500. Hence, on the first 2 million is taxed at 402,000 pesos 500, and in excess thereof is 55,500 times 32%, equivalent to 17,760. Hence, total income tax payable is 420,260. Note, in addition, X has to pay the 3% percentage to the BIR based on her gross receipts. Number 9. In 2017, X rendered some services in favor of C, customer. In payment thereof, X received a post-dated check with a face value of 100,000. The PDC, with maturity in 2019, X took the PDC to his friend and had it discounted less 15%. On maturity, C paid the PDC. How much income is subject to tax in 2018? B. Is their income reportable in 2019? How much? Answer to letter A. The face value of the PDC, which is 100,000. Letter B. Face value of PDC, which is 100,000. Discount of 15% equals 15,000. Less amount declared as income, taxable income, of 85,000. Income taxable in 2019 is 15,000. Number 10. X is an amateur chess player and she represented the Philippines in the International Women's Chess Tournament in California, USA. She won the championship there and received the following prizes. A. US dollar 10,000 cash prize. B. 1-year educational scholarship in University of California. Letter C. Talent fees of 50,000 US dollars from Nike Sports. D. 60 inches TV from Samsung. And E. Various gifts from Filipino communities in USA. X shipped the prizes, TV, trophy, and various gifts received from friends and from the Filipino communities back to the Philippines, as she has yet to visit other states and universities giving speeches. Are the prizes X received taxable? Answer: A, B, D, and E are exempt from income tax because they were received by X as prizes in connection with the chess tournament. C is taxable, which is the talent fees of B US dollars 50,000, as it is an income not related to the sports competition. The shipment of her other prizes and gifts to the Philippines is subject to VAT and customs duties because these impositions are entirely different from income tax that X is exempted from. Number 11. The BOD of X Corporation decided to transfer its own shares of stocks to 10 of its loyal employees who started their employment since X business inception, not only to secure their loyalty, but to reward them as well. Is there any tax implication under the given facts? Yes. The transaction is subject to income tax. When the corporation transfers to its employees its own shares of stocks as remuneration for services rendered, the fair market value of the shares at the time it was given is taxable to the employees. Doctrine of proprietary Tarry interest. 12. Cedric works as a barber in a saloon. Every day, he receives tips from his customers. A. Is he subject to income tax on the tips he receives from his customers? Yes. Cedric is subject to income tax on the tips he receives from his customers because he receives them by reason of his employment. The income, however, is not subject to withholding tax because between him and his customers, there is no employer-employee relationship. 13. X works with a manufacturing concern as a field worker who travels regularly to the different provinces, showing sample goods. He books orders from customers and sends them to his office for delivery. X receives regularly 15,000 pesos as his transportation, hotel, and food allowances. Is the 15,000 part of his compensation income subject to income tax? The general rule is that transportation and other bona fide expenses which are received by employees in the performance of their duties are compensation income taxable to them. However, under the given facts, if X is required to account or liquidate the 15,000 and to return the excess, if there be any, then the 15,000 is not taxable to him. If there is no requirement to return any amount thereof to his employer, X shall report the 15,000 as part of his salary earned. 14. X is a bank employee. Among the benefits she enjoys in the bank is a 15-day sick leave and 15-day vacation leave. Last year, X was hospitalized and she had fully utilized all her sick leave allowances. In addition, X had utilized only 5 days of her vacation leave. The remaining 10 days was monetized to her at the end of the year. Briefly discuss the taxability of the 15-day sick leave and 15-day vacation leave of X. Both the 15-day sick leave and 15-day vacation leave constitute compensation income of an employee. Thus, the salary of X on vacation or on sick leave, which are paid to her, notwithstanding her absence from work, constitute compensation income to her. However, if the value of unutilized vacation leave or sick credits is equivalent to 10 days and below during the year, it shall not be subject to income tax because they are classified as benefits de minimis of small value, which is exempt from income tax. This principle is applicable only to employees in the private sector. Note: the RATA, Representation and Transportation Allowance, and PERA, Personal Economic Relief Allowance, of government employees are not taxable compensation income to them. The ACA, Additional Compensation Allowance, granted to all officials and employees of the national government agencies, SUCs, GOCCs, LGUs, and GFIs, government financial institutions, is part of other benefits which is not subject to income tax if the amount is 90,000 pesos and below. Attorney Mondrigo Monte is the acting dean of the College of Law of C University. He was advised to pursue a postgraduate degree of Masters of Laws as required by the Legal Board of Education to officially hold the position of deanship. His study was financed by the university. Is the study grant subject to fringe benefit tax? Answer is no. The study grant is not subject to the fringe benefits tax of 35%. The postgraduate degree is a requirement for the position, and it is directly connected with the trade or business of the school. The university is not allowed to appoint a dean without a postgraduate degree. If the school is willing to shoulder the tuition fees of the professors pursuing their postgraduate studies on condition that the subject employees shall remain under the employ of the employer for a period of time, the cost of the educational benefits is not subject to the fringe benefits tax. However, the cost of the tuition fees shall form part of the compensation income of the professors subject to income tax. 16. The Legal Education Board requires all faculty members of the College of Law to possess the minimum paper qualification of a completed postgraduate study. X University sent 6 of its law professors to the graduate program of Y University free of all expenses, tuition fee, books, etc., on condition that for every year of study, the subject professor will render a 3-year of teaching in the College of Law. Is this benefit taxable to the law professor, or is it considered a gift that is exempt from income tax? Reason: when the recipient of the benefits are required to render substantial future services as a condition of receiving the prize or award, the value of the benefit is taxable to the recipient. Hence, the professors on study shall report the cost of the graduate program as part of their gross income, subject to income tax. 17. Many employees or officers of big corporations receive not only the mandated 13-month basic salary at the end of the year. X regularly receives year-end bonus of up to 17th month. Are the benefits of X subject to income tax? Answer: the 13-month pay equivalent to the mandatory 1-month basic salary of officials and employees from work, private and public, including other benefits such as Christmas bonus, productivity incentive bonus, loyalty award, gifts in cash or in kind, and other benefits of similar nature actually received are considered exclusion, which are exempt from income tax during the year, provided that the total amount does not exceed 90,000 pesos. Hence, if all benefits of X added together has a value of 345,000 pesos to 255,000 in excess of 90,000 pesos shall be taxable. In 2018, X received from the BIR a tax refund for excess withholding taxes. Is the tax refund taxable to X the year he received it? If the tax refunded is a non-deductible tax for income tax purposes, the refund is not taxable. Withholding tax is a non-deductible tax under income taxation. Hence, X need not report the tax refund he received from the BIR for income tax purposes. Note: non-deductible taxes under income taxation: income tax, state and donors taxes, final withholding taxes, VAT, special assessment, energy tax, stock transfers tax, and war profit tax. 19. Under an international treaty, airlines with landing rights in our country are exempt from excise tax on aviation fuel. Japan International Airline has landing rights in our country. It buys aviation fuel from Shell, Philippines. Shell passes on the excise tax, indirect taxes, on gasoline to JEL. JEL did not notice the excise taxes that were included in the purchase price. Several months thereafter, JEL discovered the error and filed a claim for tax refund of the indirect taxes on its purchase of aviation fuel. The BIR denied the claim. Is the denial valid? Why? Yes. The denial is meritorious. If the tax is an indirect tax, the proper party to question or seek a refund of it is the statutory taxpayer, the person to whom the tax is imposed by law, and who paid the same, even if he or it shifts the burden thereof to another. The proper party to claim is Shell and not JEL, and if Shell succeeds in its claim, it has the obligation to return to that to JEL. Silk Air vs. CAR, November 14, 08. 20. X, a businessman, deducted bad debt from his gross income, which he was able to ascertain to be worthless. A year thereafter, his debtor, D, came back to pay the bad debt, having won the lotto. Should X declare the amount he received for income tax purposes, or is it exempt from income tax for reason that it is a mere return of capital? Reason: when X recovered the bad debts he had previously claimed as deductions, he was already benefited under the law. Hence, the recovery thereof after deduction is not considered mere return of capital, but it shall be considered a fresh income subject to income tax. It shall be included as part of X's gross income in the year of recovery because he cannot be benefited twice at the expense of the government. Hence, bad debts that were deducted but subsequently paid shall be considered fresh income subject to income tax. This is referred to as the recapture rule or the tax benefit rule. 21. A. X has a vacant lot which he sold to GOCC. Is the transaction taxable? What taxes, if any, is payable by X? B. If a portion of X vacant lot was expropriated by the DPWH to give way to road widening, is X taxable on just compensation payable to him? Answer. Letter A. Yes. The transaction is taxable because it is a voluntary sale, considering that the buyer of his real property classified as capital asset is a government, national or local, or any of its political subdivisions or agencies including GOCCs. The seller X shall have the option of paying the 6% capital gains tax or subject his gain, if there be any, to the normal income tax. The choice belongs to X. Letter B. If X property is expropriated in voluntary sale by the government for public use, the transaction is still subject to tax. Upon release of the just compensation to X, DPWH shall withhold the 6% capital gains tax from the proceeds and remit the same to the BIR. X cannot avail of the alternative taxation, like choosing between 6% CGT or the normal income tax. 22. Today, X is 45 years old, and he has worked with F factory for at least 18 years. F has recently purchased equipment and machineries. As a result, X, together with some of his co-employees, will be retrenched. Should X receive from the company $150,000 separation pay and comes to you to inquire whether his money is subject to income tax because his supervisor told him to declare it for tax purposes, having failed to meet the 50 to 10 years rule in income taxation, what will be your most esteemed advice? Ex-supervisor is wrong. The 50 to 10 years rule in income taxation applies to optional retirement benefits and not to separation pay of an employee. Amounts received by reason of involuntary separation remain exempt from income tax, even if X at the time of separation is below 50 years of age and has rendered less than 10 years of service. In fact, separation pay can be exemption as many times as there are provided the employee is severed from the service and the reason thereof is not initiated by him or is beyond his control, whereas optional retirement benefit is exempted only once. 23. S. The supervisor of the firm had an urgent meeting with 15 regular employees of the company who have worked for more than 10 years with the firm. S informs the employees that the company is incurring huge losses in the last 3 years of their operation, and he was saying that it is inevitable that some of them will be retrenched. He informed the employees that management will offer 50,000 pesos for those who will be voluntarily resigned. According to her, this offer is the better option rather than wait to be retrenched, as that would have the implication of inefficiency on the part of the employee. A. If X voluntarily tendered his resignation and received the 50,000 separation pay, is the amount taxable? Letter B. If Y refused to tender his letter of resignation, but the company terminated him and was paid 50,000 pesos, is the amount taxable to Y? C. Z refused to accept the offer, but he was terminated anyway without having paid any single centavo. If Z filed a labor case against the firm and subsequently won, where he was awarded with back wages and reinstatement, is his back wages subject to tax? Reason. Answer to letter A. Yes. The amount is taxable because X voluntarily resigned from service. The principal reason for cessation from work is his resignation and not the losses being suffered by the company. Resignation is an act that is within the control of the employee. Letter B. No. The amount Y received is not taxable because the cost of his severance from employment was termination due to retrenchment, a cost which is not within his control. Letter C. Back wages awarded to an illegally dismissed employee is subject to income tax for reason that the money represents salary actualized. It is also subject to withholding tax. 24. X was terminated from his job due to his undesirable attitude and willful disobedience of the lawful orders of his employer. After a meeting with the manager, X was given financial assistance of $25,000, but has to leave the service. Is the money taxable to X? Why? Termination of employment by the employer due to willful disobedience of an employee of the lawful orders of his employer, inefficiency, undesirable attitude, dishonesty, moral depravity, or serious misconduct are deemed costs which are not beyond the control of the employee. Hence, any financial assistance or money given to subject employee who will be terminated for the causes herein stated is taxable to him. 25. X owns a vacant lot and desires to lease the real property. A lease contract was drawn and among the stipulations agreed upon are: A. Y will construct a 4-story commercial building at his exclusive expense on the lot, and the building will automatically belong to X at the end of the 20-year contract. B. The annual real property tax on the land and building shall be paid by Y during the lifetime of the lease contract. C. Y will extend a loan of $300,000 to X, which shall be gradually deducted from Y's monthly rental of $75,000 at $20,000 per month, beginning on the second year of the lease contract. What are the tax implications under the above agreements between X and Y? A. The monthly rentals of $75,000 is income to X. In addition, when the lessee makes improvements on the leased premises and said improvements will belong to the lessor upon the termination of the lease contract, the lessor X may at his option report income using 1. The outright method, report as income the fair market value of the improvement in the year of completion, or B. Spread out method, spread over the remaining term of the lease the book value of such improvements at the termination of the lease contract. Letter B. The real property taxes paid by Y on behalf of X shall be considered additional income to the lessor and constitutes income taxable to X. C. The loan extended by Y to X will still form part of the income of X taxable to him. 26. A. X took a life insurance policy with a term of 15 years. Her total contribution amounted to 200,000 pesos. She outlived the policy and received from the insurance company her life insurance proceeds of 320,000 pesos. Is the money X received subject to tax? Answer. Since X outlived her insurance policy, the money returned to her is taxable, but only the 120,000 pesos, being the excess of her total contribution of 200,000 pesos. The later amount is not taxable, being a mere return of her capital. One important requisite in order that proceeds of life insurance shall be exempt from tax is the death of the insured. B. If X is beneficiary of a 1 million policy on her father's life and upon his death, X elects to receive 220,000 every year for 5 years instead of lump sum, is there any difference in your answer? The 200,000 she receives every year is tax exempt. but the $20,000 remaining is taxable, being interest earned from the life insurance proceeds. C. X took out a life insurance policy and named his wife and 4 kids as beneficiaries. X paid only 5 months premium in the total amount of 15,000 pesos and suddenly died of a heart attack. If the heirs received from the insurance company the life insurance proceeds of 500,000, is the amount in excess of X contribution taxable to the heirs? Why? No. Proceeds of life insurance policies paid to heirs or beneficiaries upon the death of the insured, whether in a single sum or otherwise, are excluded from gross income. However, if such amounts are held by the insurer under an agreement to pay interest thereon, the interest payments shall be included in gross income. The reason for its non-taxability is that such proceeds are considered more as an indemnity rather than as a gain or profit. Alfredo inherited from his uncle an apartment located in Baguio City worth 12 million. The real property has an annual lease income of 600,000. How much income is taxable to Alfredo? The 12 million apartment is not subject to income tax, but the estate tax because inheritance is considered capital. Only the 600,000 lease income of the apartment is subject to income tax. 28. X has a grocery store. In 2018, he realized gross sales of 2,350,000 and incurred operating expenses of 1,150,000. If he comes to you asking what is the use of the optional standard deduction in income taxation, what will your answer be? Businessmen and professionals are given 2 options on how to deduct their expenses. The A. Itemized standard deduction, ISD, and B. Optional standard deduction, OSD. The OSD, in lieu of the ISD, X may elect OSD in an amount not exceeding 40% of his gross sales or receipts, as the case may be, provided 1. His intention to use this method as signified in his first quarterly tax return during the taxable year or in his initial quarter return after the commencement of a new business, and B. Once the election is made, this is irrevocable for the whole taxable year. The purpose of the USD is to facilitate the audit or review of taxpayers' returns because there is no need on the part of the BIR to determine which items are deductible and which deductions are allowed under the law. The 40% deductions does not require supporting receipts. Non-resident aliens are not allowed to use this method of claiming their expenses. Taxpayers who have chosen the 8% flat tax under the train law are not allowed to deduct their expenses, so they may not avail of the USD. Corporate taxpayers using this method to deduct their expenses shall use their gross income as tax base for the 40%, whereas individual taxpayers use their gross sales or gross receipts as tax base. 29. Income earned by resident citizens of the Philippines that are subject to final withholding taxes and not to income tax. Answer. Interest earned from currency deposits in banks' peso account, 20% final withholding tax. B. Interest earned from foreign currency deposit in banks, 50% final withholding tax. C. Royalties, 20% final withholding tax. D. Royalties on books, literary works, and musical composition, 10% final withholding tax. E. Prices in excess of 10,000 won within the Philippines, 20% final withholding tax. F. Lotto and sweepstakes winning in excess of 10,000, 20 FWT. G. Cash and property dividends, final withholding tax 10%. H. Capital gains from sale of shares of stock not listed in the exchanges, 15% final withholding tax. I. Capital gains from sale of capital assets of real property located in the Philippines, 6% final withholding tax. Proceeds of pre-terminate time deposit of more than 5 years, 4 years, but less than 5 years, 5% final withholding tax. 3 years, but not less than 4 years, 12% final withholding tax. Less than 3 years, 20% final withholding tax. 30. Taxation of partnership and partners. Partnership is taxed like a corporation. Unregistered partnership is also taxed like a corporation. Share in the profit of the partnership shall be taxable to the partners only in their separate and individual capacities. Partners shall be taxed on their share whether the profit has been distributed or otherwise. Under the doctrine of constructive receipt of income, the partners have the control and the right to decide as to when and whether or not the profits should be distributed to them. Kinds of partnership. Exempt partnership such as general professional partnership. These are partnerships formed by persons for the purpose of exercising their common profession, and no part of their income is derived from engaging in any trade or business. Reason for exemption. The GPP is exempt from corporate income tax because it is only acting as a pass-through entity where the income is ultimately taxed to the partners comprising it. However, it is subject to business taxes. It is required to file an income tax return of their income for the purpose of giving information to the BIR as to the share in the gains or profits which each partner is entitled to. Income payments, drawings, allowances, advances, sharing, stipends, etc., made periodically or at the end of the taxable year to partner of a GPP shall be subject to a creditable withholding tax of 15% if the gross income in 1 year exceeds $720,000 and 10% CW tax if income is $700,000 and less. For purposes of computing the distributive share of the partners, the net income shall be computed in the same manner as a corporation. The GPP may claim the itemized standard deductions, ISD, or the optional standard deduction, OSD, in the amount not exceeding 40% of its gross income. If the partnership availed of the ISD in computing its net income, the individual partners cannot avail of deductions anymore in computing the respective income tax on their share in the net income of the partnership because the distributive share from the partnership is already net of costs and expenses. If the GPP avails of OSD in computing its net income, the partners can no longer claim further deductions from their share in the net income for the following reasons. A. The partner's distributive share in the GPP is treated as gross income, not his gross sales or receipts, and the 40% OSD allowed to individuals is specially mandated to be deducted not from his gross income but from his gross sales or receipts. And B. The OSD is in lieu of the ISD in computing taxable income will appear for both the items of deduction allowed to the general professional partnership and its partners. RR 2-2010. Under the train law, a GPP and the partners comprising such partnership may avail of the optional standard deduction, OSD, of 40% only once, either by the GPP or the partners comprising the partnership. The partners comprising the GPP can A. no longer claim further deductions from their distributed share in the net income of the GPP, and B. are not allowed to avail of the 8% income tax rate option since their distributed share from the GPP is already net of costs and expenses. If the partner has other income derived from trade, business, or practice of profession apart and distinct from the share in the net income of the GPP, the deduction that can be claimed from the other income would either be itemized deductions or OSD. An individual taxpayer who opted to avail of the OSD shall not be required to submit with his tax return such financial statements otherwise required under the tax code. All other taxable partnership, they're taxed like a corporation. The rules on corporate taxation, such as the filing of quarterly income tax return, the rules on deductibility and non-deductibility of expenses incurred, tax rates, etc., are applicable to them. Tax on co-ownership. Co-ownership is exempt from corporate income tax if the activities of the co-owners are limited to the preservation of the property and the collection of the income therefrom. Upon distribution of the net profits to the co-owners, they shall be taxed separately and individually based on their distributed shares. 32. X and Y are cousins. They bought 2 parcels of land from Z, another cousin, who is leaving for abroad, in 2015. In 2016, X and Y purchased the inherited property of Z, consisting of 2 agricultural lands. In 2018, X and Y sold all the real properties and realized a gain of $2 million and divided the same equally between them. Is an unregistered partnership formed by X and Y, thereby subjecting them to corporate income tax? No unregistered partnership was formed between X and Y. The mere sharing of gross returns does not of itself establish an unregistered partnership. To be such, there must be an unmistakable intention to form a partnership or joint venture. Under the given facts, there is no showing that the joint purchase was for the purpose of earning profits to be divided between them. 33. W, X, Y, and Z inherited from their last parent income generating properties. Every year, they divide the net income therefrom equally. The tax official learned of this arrangement and subjects the income to corporate income tax of an unregistered partnership because the business is owned by 2 or more persons. Is the tax official correct? Why? Co-heirs who inherited properties which produce income should not automatically be considered as partners of an unregistered partnership or corporation, subject to tax if there is no contribution or investment of additional capital to increase or expand the inherited properties. Merely continuing the dedication of the property to the use of which it had been put up by the forebears. Obelius versus CIR. 34. In the above problem, granting that the co-heirs decided to sell the inherited property and realize a profit of $8 million, is the gain subject to corporate income tax? No. The gains realized is not subject to corporate income tax because the sale does not necessarily establish their intention to form an unregistered partnership. 35. Upon due investigation, the tax official was able to determine that X has underdeclared his income by more than 50%. A. What kind of penalty is imposable against X? B. May the government collect deficiency interest and delinquency interest at the same time? When a return filed is fraudulent, substantial underdeclaration of more than 30%, there shall be imposed a surcharge of 50% and not 25%, because the latter is for late payments or late filing of the return, and an interest of 12% per annum on the basic tax. B. In no case shall double imposition of interest be allowed, like the deficiency and the delinquency interest simultaneously imposed.